Good Monday afternoon to you. Welcome to the John Sanchez Show on News Talk 780 KOH. It's a pleasure to be with you. Happy Monday, as I said. I hope it was a start to a good week for you. And you had a great weekend. Oh, kind of crazy weather out there today. My goodness. I almost feel like winter's coming back or something. Anyways, thank you so much for joining me. I got a great show lined up for you today. We're going to recap today's stock market activity, of course. Talk about the latest events that unfolded over the weekend, as well as today in regards to not so much the U.S., but Iran and Israel. Yeah, potentially we've got some good news. We'll see if it happens here, but I'll definitely share it with you. Then I'm going to get into our topic today. You know, most people spend literally decades, many of you do, following the same advice. Save consistently, invest prudently, and of course, defer taxes wherever possible. Well, this works until you retire. After working with thousands of retirees over my career, I have found the same pattern over and over again. It's not the markets that derail retirement plans, but it's the tax surprises that people never plan for. Well, today I'm going to share with you 9 of those tax surprises that I've, again, dealt with thousands of times over my career. So if you're a retiree or soon to be retiree, I want to leave you with one little piece of advice before I get to the stock market recap, and then we get to our topic. And that is, remember that old basic saying that we've all heard growing up. It's not what you make, it's what you keep. And again, it's even more important when you're a retiree. So you don't want to miss these 9 tax surprises that retirees should never, ever forget. All right. In the meantime, let's go back to the stock market side of things today. So it was very interesting. I'm sure many of you saw on your favorite news channel or radio show, whatever it may be, over the weekend that Iran fired against Israel, Israel fired against Iran, and it looked like everything was unfolding, unraveling, I guess is a better word. And then all of a sudden we find ourselves today. The president came out today and basically said, you know, things are going to get resolved. Don't get too worried about things. And the market kind of just took it in stride. Oil prices didn't really move up all that much. We're up a little over $1 or so. But then in the pre-market session, the news came out. And again, I'm gonna laugh as I say this, because once again, we have said many times that one side will say one thing, another side will say the other, and bottom line, nothing ends up happening. But if you can believe what I'm about to tell you, then help yourself. Iran came out early this morning and said they were halting their strikes against Israel, but they will resume hostilities if the Israeli Defense Forces continue to attack Lebanon. Then Israel Prime Minister Netanyahu later comes out and says the war against Iran and its Lebanon-based proxy Hezbollah has not ended yet. The president came out today and said, or he insisted, that final peace negotiations are ongoing. So you sit there and you kind of, again, you scratch your head and go, okay, how many times have we heard this? How can it be that just roughly 48 hours or so ago, 72, let's be on the safe side, missiles are flying back and forth. And then all of a sudden you wake up one day on a Monday morning and you go, you know what? This war is over. It doesn't make any sense to me. But again, Iran's military says they have ceased strikes against Israel, but again, would resume those if Israel continues to attack Lebanon. So you just kind of sit there and you wonder, is this really legit? Because actually it was Sunday night that they traded lobbing of missiles back and forth. And that, again, was during the time period that there's supposed to be a ceasefire between the two companies. The Islamic Republic fired missiles towards northern Israel after accusing Jerusalem of reportedly violating the truce through its strikes on Lebanon, which included attacks on Beirut's southern suburbs on Sunday. Israel said they carried out a, quote, large-scale strike on strategic defense systems in response. This morning in Truth Social, the president said that despite these latest outbreaks, both Israel and Iran are, quote, looking to do an immediate ceasefire. And then lo and behold, here comes the news headlines. The president said the following, quote, final negotiations on, quote, peace are proceeding, subject to ignorance or stupidity getting in its way. He added that an ongoing U.S. blockade of Iranian ports in the Gulf of Oman will not be lifted until, quote, a final deal is reached. He said things should move quickly. We just crossed our 100-day mark, by the way, on this war on Sunday. And again, earlier this morning, the president in True Social said Iran and Israel must immediately stop shooting. In a phone call with the Financial Times yesterday, the president said Netanyahu, quote, listen to this one closely, Netanyahu won't have any choice, that's a quote, but to accept a deal that the U.S. negotiates with Iran because I call the shots, unquote. So those are the latest events over about the last 24 hours. However, an Iranian official earlier Sunday appeared to cast doubts whether any agreement with the U.S. was forthcoming, telling MS Now, quote, a deal with President Trump is no longer feasible at this stage. The official blamed Trump for the situation in Lebanon and the current escalation in hostilities. Now, here's the interesting part, right? We always have to take a market perspective on this. Would you not think, I mean, it's common sense, would you not think that if the street did actually believe that a ceasefire was going to hold and it's legitimate and everything that you want, the market would skyrocket? Well, it didn't. It was an okay day on the NASDAQ, had a loss on the Dow. Dow lost 81 points, closing at 50,786. NASDAQ gained a little bit back from the loss of the trading session on Friday. NASDAQ gained 220 points, 0.86% to 25,929. And the S&P 500 for the day was up 22 points or 0.30% to close at 7,405. But hopefully you heeded my advice on Friday, right? If you missed the show on Friday, well, it was a brutal day. Hopefully you didn't check your portfolio. I'm just kidding. Because Friday was a very tough day, right? We lost significant value, 695 points on Friday we lost on the Dow. The NASDAQ was the trouble child, down for over 4%, 1,122 point loss on Friday, S&P down 201 points. But I told you on the show on Friday, this is a heck of a buying opportunity, right? You had the likes of Broadcom on Friday down $33 and change, Micron down $132, Intel down $12, almost $13, NVIDIA down $13.55. So, like I said, there was no news really on Friday. We had a couple things go on. We had bond yields rise, etc. And I said, use that as a buying opportunity. Well, if you did that, you'd have been rewarded. Because today, NVIDIA went up $3.54. Obviously, not the damage that was done on Friday, but that was a 1.73% gain to 208.64. By the way, this is kind of interesting. And I looked at this and kind of heard this with, I'll use my one eyebrow raised, one eyebrow down philosophy. The CEO of Intel, of course, of NVIDIA, Jensen Huang, said over the weekend that the pullback creates a buying opportunity. Now, I will tell you, I can't remember the last time, if ever, I have heard a CEO come out and say a pullback in their stock created a buying opportunity. Usually CEOs don't want to take that liability risk on. Now, what I don't know, to give Jensen Huang, a genius in my opinion, the credit is, was he referring to tech in general, or was he referring to his stock specifically? I could not find any specifics on that. But like I said, if he was referring to his company, NVIDIA, and the loss that it sustained on Friday, again, find that very unusual. And is it good for a CEO to come out and kind of play cheerleader for their own stock? Again, those are things that get people in trouble. But we'll see what happens. But NVIDIA wasn't the only gainer today in the semiconductor space. This whole group was strong today. We had Intel up $11.10, 11.19% gain to 110.27. You had Corning, which struck a huge deal with a multi-billion-dollar deal with Amazon to provide an fiber optic infrastructure basically with Amazon. And again, Corning was just so strong. GLW's the symbol, $9.96 gain, 5.61% to 187.54. Amazon was down 81 cents for the day to 245.22. Marvell Technology, which was another one beaten up on Friday, nice rebound here, $25.38 gain to 288.85. Apple lost $5.80 though, down 1.89% to 301.54. They reversed a 3% gain after underwhelming investors at the Worldwide Developers Conference, where it introduced Siri AI and other AI features for its products. So the street wasn't impressed. Another big standout real quick, it was Tesla, up $17.90 to 408.90. Remember, SpaceX is supposed to do the IPO this Friday. It's going to be a big one. Welcome back to the John Sanchez Show on Newstalk 780 KOH. Happy Monday to all of you. Again, a fairly decent day today. Nothing too crazy by either direction. Finished down 81 on the Dow. NASDAQ rose 220. The S&P higher by 22. Again, just a small dent on the S&P and NASDAQ's loss on Friday with the gains today. But hey, step in the right direction. On the commodity side, we gained about 69 cents on oil, 91.20 a barrel. Gold was quiet, just a $4.10 decline, closed at $4,303.30 an ounce, and a 2 basis point increase on the 10-year Treasury at a yield of 4.58%. All right, let's see. Do want to mention this before I get to our topic this afternoon, which again is 9 tax surprises retirees should never forget. It was announced today that OpenAI, of course, the parent of ChatGPT, has confidentially filed for an IPO with the Security and Exchange Commission. This, of course, sets the stage for what could be one of the largest public market debuts in history. Obviously, no date is set. What does confidentiality mean? It means they've filed their financial statements, which again, as a private company, really no one has seen per se, but now they filed those financial statements with the SEC for validation and so on and so forth. So rumor kind of has it right now it'd be the fourth quarter of this year that OpenAI would go public. Again, as a reminder, this Friday is the expected IPO of SpaceX. Again, they wrapped up their road. We're still doing their roadshow. It started last week. But that one should go down in history as the biggest. But I think OpenAI and even Anthropic could definitely give them a run for their money. Anthropic, by the way, filed last week. So, this could be blockbuster. They're saying that OpenAI is valued at about $850 billion is basically what they're looking at. So pretty doggone close to SpaceX. And some analysts are saying it's north of $1 trillion that they're worth. But, time will tell. A lot of concern. Like I said, a lot of concern in regards to what happens. Historically, IPOs, at least in the last few years, have not done well. This could be obviously a unique situation because it is SpaceX and it is AI. So everyone's going to be watching this one very, very closely. And then, of course, they'll turn their attention to whenever OpenAI and Anthropic and whatever other AI-related companies decide to go public this year. It's definitely the year that everybody has been waiting for. So it's going to be a fun one. Don't miss the show on Friday. I'll give you all the details. Where do we sit on a year-to-date basis after Friday's drubbing? Well, still pretty solid. We got the Dow higher by 5.7% year-to-date. S&P's up 8.2%. The Russell 2000 up 15.1%, and the Nasdaq's higher by 11.6%. All right, I'm going to get a head start on our topic today because, again, this is a very, very important topic for those of you either in or very near retirement. Most of the tax surprises and again, I'm going to focus in on you retirees. Most of the taxes are avoidable. Some are not, like your RMDs that I'll get to. But as I've said many times on this program, many retirees are not ready for the shift of retiree taxes because they show up in different areas. The biggest, and this isn't part of my 9 points, but I'll just mention this right off the top. One of the biggest issues, of course, is like I said, many, many times on this show, is the surprise when a retiree gets their first tax return done after they've become retired. And they think everything is fine until the tax professional says, guess what? You get to pay quarterly taxes because you didn't have enough money withheld. Well, what do you mean have money withheld? Don't know what you're talking about. They used to always happen when I work for somebody. It's a common mistake, but it doesn't have to be. So that's always one of the biggest surprises because now you're going to be shelling out some extra money on a quarterly basis and so on and so forth. But I want to start this discussion with you on my first point about the tax surprises of a retiree and really lay out something that for some of you may seem very obvious, but for others that are approaching retirement or maybe they're newbies in the world of retirement may not know. So I want to kind of start with this somewhat basic. Let's talk about a title of not all income is created equal. Not all income is created equal. By no means is it. So you spend your working years, income's pretty straightforward. You make a paycheck, you have some withholdings taken care of, and you're done. Maybe you owe a little, maybe you get a little return at the end of the year, and then that's it. Look quite a bit different when you're retired. Where does most of your income come from? Well, again, pensions are not real popular, so a lot of your income is going to come from your IRAs, your 401ks that you probably moved to an IRA rollover account, etc. So remember, our first bout of income, the IRAs and 401k withdrawals, fully taxable. That is, of course, unless you take advantage of the Roth 401k or the Roth IRA. Then, of course, if you've had it in there for 5 years and you're over 59 and a half, it's not taxable. But any other traditional form of IRA, it's taxable. And again, if you're taking a good majority of your income from your IRA, that could be a significant sum of money and therefore significant taxes. But it's not capital gains, it's taxable income. Social Security, well, of course, we know that part of Social Security is taxable. Investment income, that varies, right? If you have a taxable investment account that you're drawing off of, or not even drawing off of, but you got a taxable account that you got two things going on. Maybe you own some positions in stocks, ETFs, mutual funds that spin off dividends. Okay. That could be taxable income depending upon your rate and the type of dividend, whether it's a qualified dividend or not. But of course, capital gains. Something sold for the short term, it's taxed at your tax rate. Something sold after 12 months, it's a long-term capital gains rate. But that also surprises people. And then again, Roth withdrawals, non-taxable as long as those rules are followed. Now, let's talk about the taxes on the Social Security side. For those of you you're not of Social Security age, or maybe you are of age, but you haven't taken it yet. So a lot of people are very surprised to learn that up to 85% of their Social Security benefit can be taxed. Now, these taxes are triggered by something called provisional income. Now, how much tax you pay on Social Security is determined by other forms of taxable income that you make. See, that's what's meant by provisional. So the more you withdraw from tax-deferred accounts, like 401ks, IRAs, etc., the more likely your Social Security benefit becomes taxable. It's not a smooth, predictable curve by any means. If you have changes in your provisional income, that can create what's called the tax torpedo, when small increases in income lead to disproportionately higher taxes. Remember a few weeks ago when I did a show on this, that's where, again, you have the different tax rates, different tax brackets. And when I was talking about Roth conversions, remember when you convert a taxable or a tax-deferred account into a Roth, that's taxable income in that year. That could bump you up into one of these higher provisional levels and create the provisional income. So you got to be very, very careful. And like I said before, make sure that you coordinate well with your financial advisor if you have one, with your CPA, so on and so forth. Because again, people think, oh, it's so easy. Yeah, of course I want to convert my Roth IRA. I can pay the taxes this year, but they forget about the impact that it has on Social Security. They also forget about the impact on this thing called Medicare IRMA, which I'll cover in my point 3 as we discuss 9 tax surprises retirees should never, ever forget. All right, let's get down to our topic. We just started. 9 tax surprises retirees should never forget. But first, a brief recap of what happened today in the market. Once again, it was a lackluster day on the downside, lost 81 points. The NASDAQ gained 220 and the S&P higher by 22. Once again, just a little bit of a dent into Friday's losses, unfortunately, which could have been a bigger day today. All right, let's get back to our topic. So, once again, we're talking about the surprises that I see that I've dealt with for years and years with clients. The retiree tax surprises, I like to call them. I put together a list of 9 of the most common ones that I've seen. Just to give you a brief recap, once again, the first one is, one that realizing that not all income is created equal, right? The IRAs and 401ks, those are taxable income to you. Social Security is partially taxable. Investment income varies. You have capital gains, you have dividend income, and so on and so forth. And then, of course, Roth withdrawals can be tax-free if all the rules have been followed. Then I mentioned taxes on Social Security. People are surprised to learn that up to 85% of their Social Security benefit can be taxed. But I left off in my third point. This is a really important one. I touched on this about a month or so ago on the show, and I want to go over this again. And this is called the Medicare IRMA, IRMAA, and that stands for Income-Related Monthly Adjustments, IRMAA. Most retirees, or new ones especially, don't realize that their Medicare premiums are tied to their income. Again, this is called IRMA. The higher reported incomes can increase your Medicare premiums significantly. So if you have a large IRA withdrawal, that can trigger IRMA. If you have a big bump up in any form of income, that can trigger an IRMA. Now, what is IRMA? Okay, so here's the interesting situation to understand with IRMA. So IRMA, once again, is something that is based upon your income. And what a lot of people don't realize, because again, this is a really, really complicated area. What a lot of people don't realize is just going over the IRMA threshold by just $1 could cost you over $1,100 a year. Here's what I mean. So the IRMA threshold for 2026 is based upon your 2024 modified adjusted gross income. Remember, when we're talking about IRMA, it looks back over the previous 2 years. So again, your 2026 Medicare IRMA is based upon your 2024 modified adjusted gross income. Now, the first IRMA surcharge begins when your modified adjusted gross income exceeds $218,000 if you're married and file a joint, or if you exceed 109,000 if you're single. So like I said, here's the example. There's different tiers based upon where your income falls. That determines how much you have to pay in IRMAA. So think about this for just a second. So you're married, right? You file jointly and you make $218,000. Okay, IRMAA doesn't come into play when it comes to your Medicare calculation. But literally, folks, if you make $218,000 and a penny, just $1 over the IRMAA threshold, that can trigger about $1,148 a year in additional Medicare premiums between the Part B and the Part B. That's why you got to be very careful when we're doing Roth conversions, capital gains harvesting, IRA distributions, business sales, things like that. So again, this is a really, really common one that you don't see a lot of advisors really get involved with, but they should. And now you know that you need to ask about it. So be very careful when you're a retiree and you're doing this. Talk about number 4. Forced withdrawals. That's what we call required minimum distributions, or RMDs. Well, again, like I said at the beginning of the show, you were forced and told for the years to defer taxes whenever possible. But eventually, the IRS always collects, and that's what they call the required minimum distribution, or RMD. This forces you to withdraw money from tax-deferred accounts starting at age 73. Remember, it used to be 70 and a half. Then they bumped it up at 71, 72 during COVID. Now we're at 73. And there's some talk that it may even go higher over the next few years. But here's the problem. You're forced to take this money no matter what. Now, those withdrawals from your IRA because of RMD are fully taxable. So again, they can push you into a higher tax bracket. They can increase the Medicare premiums, as I said. They can trigger taxes on your Social Security all at once. I've seen clients reporting twice the income they need to live. So what is the solution? RMD, there is not a lot you can do. Now, I will tell you, and I need to do a show on this because I don't think I ever have. There is a tax rule now that you are allowed to donate your RMD to your favorite charity, and therefore the charitable deduction should offset a good portion, if not all, of your RMD. Okay, so to make it simple, let's say you had to take a $10,000 RMD. Then you do a donation to your favorite charity or a donor advised fund. And like I said, that $10,000 should put a pretty significant dent on what would have been the tax bill, the income tax bill, because you took out $10,000 from your IRA. Now, confusion I see a lot with clients is whether you have to do an RMD as well as you're taking your normal IRA withdrawals to live off of. And the answer is it's one or the other as long as you exceed the RMD amount. So typically, and again, this is very rough rule of thumb. Typically, your first year in retirement, your RMD, and I mean, around the 65 age group, typically your RMD is roughly 4%. So you got $1 million IRA, 4%, you got to take 40 grand out. Cool. But if you're taking anything above 40 grand, 41,000, 51,000, 100,000, whatever it is, as far as income, your RMD is not applicable. So that's what I said. Your RMD is the minimum. If you're taking out more, RMD is not applicable. But if you're taking out, let's say, 30,000 a year, as far as income to live off of from your IRAs, and your RMD is 40,000, you got to take out 10,000 more. And the other mistake a lot of people make is they're like, I've got to drain this one account. It's based upon one account. And the answer is no. It's an aggregate value. So you have to take, if you own 5 IRAs, you or your advisor takes the value of all 5 of your IRAs as of December 31st of the previous year. That's where it's based off of, adds those together, then run the RMD calculation. So it's not just based upon one, it's the aggregate of all of your tax deferred IRAs. Again, Roths are excluded. So it may be a little bit more than you think. Maybe it's a little bit less, but don't forget, I see that mistake a lot. Don't forget to add up all of your IRAs based upon previous December 31st values, then apply that towards the calculation. And remember, the older we get, the more the RMD is going to be. But also at the same time, if your IRA is not growing, let's say your RMD is at 4% your first year, and let's say in 2 years it's at 5% of the account value. Well, guess what? If your account hasn't grown, maybe you went through a tough market condition, you did other withdrawals, whatever the case is, remember, it's always based upon that December 31st value. So don't assume your RMD is going to increase every year. Now, if stars line up, your account increases in value, you don't take any unusual withdrawals, yes, you're going to see that 4% turn into 5, turn into 6, so on and so forth. Because the way the RMD is calculated is based upon your life expectancy. The older we get, the less life expectancy that we have. So therefore, the IRS wants you to drain that even further. So they sound really simple, but they again, they can be very, very complicated. And that's where, again, a good advisor will highlight and help you make those calculations. The old days, we used to have to do it by hand, but nowadays it's pretty simple with software. We can run different scenarios, etc. All right, let's go to tax tip number 5, the surviving spouse tax increase. Oh, this is a big one. When one spouse passes away, the surviving spouse moves from married, filing joint tax return, to single. But guess what? They probably have the same assets, probably have very similar income, and dramatically higher taxes. Now, this shift alone can push that surviving spouse into a significantly higher bracket, especially when combined with RMDs, with Social Security, and all the things I just mentioned. So not only are you dealing with the emotional loss of losing your loved one, it's also a financial stress point. So I will add one other little point to this also. In the event of divorce or death, keep in mind with your primary residence, remember, you can make, if you're married filing jointly, $500,000 profit without paying any taxes. But once you lose that and you're a single person, now that drops to $250,000. So you really, if you plan on moving out of that house that you had your loved one in, please make sure you do it within about 2 years, 2 to 5 years, depending upon circumstances, after the death of your loved one. If not, then you're going to be taxed as a single person, not as a joint person or joint filer. Again, very complicated. My best advice is make sure you let your accountant know if you lose a loved one and you're thinking again of selling your home. Let them know as soon as possible after the passing of the loved one for various reasons, tax returns, etc. But also to discuss the tax-free exclusion, because a lot of times people think, oh, you know what? It's $500,000. I'm cool. Everything's fine. And then again, here comes the tax bill after they sell the house. And same thing happens in the divorce, right? Remember, if you end up keeping the house out of the divorce and your spouse doesn't, same rule applies. Yet you went from $500,000 down to a $250,000 exclusion, but you have some windows that you need to, make sure that you hit the $500,000 and not the $250,000. So that's a real important one. All right. When we come back, we'll talk about point number 6, no tax diversification plus bad timing. Welcome back to the John Sanchez Show on News Talk 780 KOH. Hey, as a quick reminder, don't forget our new business, Specialized Trust.com. That's right. Specialized Trust and Estate Plans is the name of the business. We had a very, very successful webinar last week, and I'm so grateful to all of you. We'll be doing another one in about a week. I promise you that. I'm still working on the exact topic. But if we can help you with your family's estate planning needs, take a look at our process. We can create an entire estate plan for you in less than 2 hours from the comfort of your home for a price of $3,649. A lot of you are taking advantage of our young adult package. This is, again, for your children. Own children, but the ones in our minds are still our babies, right? They're a little over 18 years old, maybe 18 to 25 or so. Guess what? You can't make financial decisions, medical decisions, et cetera, for them without the proper forms, the powers of attorney, et cetera, and medical directives. And we have a young adult package that starts at about $425, so you can't beat that. So learn about our process, learn about our packages. We have 8 different estate planning packages. All of it can be found at specializedtrust.com. Really simple process. Again, you click on the start a plan. You create fill out a little real simple form, name, address, email, etc. And then that schedules a discovery meeting with me. And I'll host a 30-minute discovery meeting to find out what your needs are for you and your family. And then we'll decide what's the best package and then move forward from there. It's really simple. And again, all from the comfort of your home. I'm so proud of the business. Again, Specialized Trust. If you want any other information, just send me an email, john@specializedtrust.com. All right, I'm going to hustle here because I only have a few minutes, as usual, to finish running through this. All right, we're talking about the 9 tax surprises retirees should never, ever forget about. Let's talk about point number 6, no tax diversification plus bad timing. You may have done a great job diversifying your investments over time, right? You built up a nice chunk of money, nice nest egg, etc., but no one told you about needing to do the same for your taxes. Because it's great putting everything into a tax-deferred account, growing it, no taxes. Again, we touched on RMDs. Anything that comes out, of course, taxable income to you. But what if everything is in a tax-deferred account? Well, that becomes a problem when the markets are down. If you need income and your only option is to withdraw from a declining account, guess what? You're forced to sell more shares at lower prices and still pay taxes on the withdrawal. So my point to this is, remember, like diversification on the growth side of things, you want diversification on the income side. There should be multiple sources of income coming in. So again, you're not forced to sell out of your brokerage account in down markets. Now, keep in mind also, another really, really important point to mention is owning mutual funds in taxable accounts. Mutual funds have their place. There's no doubt about that. But here's one of the downsides, especially if you're new to the market. Mutual funds, by most account, keep somewhere between 2 to maybe 5% maximum in cash at any one time. If you get into a down market, the mutual fund company gets hit with what we call redemptions, right? So that manager sits down, that portfolio manager sits down at his or her desk every morning and says, oh boy, I've got to raise, I'll pick a number, $100 million. Well, the first thing they're going to do is they're going to sell off their winners first. Well, let's say you wanted to get out of your mutual fund. I want to stay in it, right? I'm a long-term investor. Well, they start selling off that $100 million of redemptions that day. And guess what? You're going to pay the same amount of capital gains tax that I'm going to pay, right? And you didn't even plan for it. So come the end of the year, when you get your 1090, it's going to say, congratulations, I'm paraphrasing, you owe X amount of dollars, or here's your taxable amount on dividends. And oh, by the way, capital gains. And you're like, well, wait a minute here. I didn't request to sell, right? That's what I would say, because I'm the one staying in. You're the one getting out. Well, guess what? It doesn't matter. Doesn't matter. We're both treated the same way. So be very, very careful in retirement if you own mutual funds in a taxable account. No big deal in a tax deferred account, but very, very difficult and surprising when we get into down markets and all of a sudden you get hit with a tax bill and you've seen your account value go down. My seventh point is pretty simple. The future tax laws, right? Tax rates are historically low right now. You never know where things are going to go. So you always have to stay in tune with what's going on with the latest tax rules, et cetera. Good financial advisors, as well as a CPA, tax professional, et cetera, should keep you abreast of that. And then you have to plan, right? Kind of like an estate plan, as I always say, it's a living, breathing, document. Your taxes are a living, breathing entity also, because things change all the time. Your life changes, your income, the rules change, et cetera. Next one real quick, back to the estate planning side of things. On inheritance, right? The burden the family inherits. Here's what I mean by this. Remember, when the Secure Act came out a few years ago, you used to be able to spread out, if you inherited an IRA, you're a non-spouse, you were able to spread out your IRA inheritance over your life expectancy, right? So if you're young, hey, that worked out pretty good. But guess what? Now you have 10 years to fully withdraw the inherited account. So you got to be very careful. My last one, the 99 underspending strategy. Don't underspend. Take out what you need just to account for it. God bless. Have a great afternoon. We'll see you tomorrow on the John Sanchez Show.